May I remind you that the data shows that you want a Democratic president and a Republican House and Senate. If you can tell me how to make that happen, I don't know how you make that happen. That is the best for the stock market every single time. How Republicans in the House and Senate, Democratic president get more done for the good than any other scenario in history. Welcome to a Wiser Retirement Podcast. We believe the best financial advice should always be conflict-free. I'm your host, Casey Smith. Guiding you to financial freedom today is my co-host, Andrew Pratt, and Missie Beach.
Hi, Casey.
How you doing, Missy?
Great.
Hey, Casey.
Hey, Andrew. Always excited to have you guys on here. This is a kind of a fun episode, which we kind of recap the prior year, talk about 24 and what's going to happen going forward. And I don't have any specific predictions for 24. I just wanted to be over, but we'll talk about that when we get to
already.
It's the beginning of the year.
You know, I'm not like when I was much younger. I was really not active, but just really monitored politics. I had opinions about things. And now I'm just like, let business do business. And I don't care about the politics. And this year is going to be nasty.
Oh, because of the election year.
Because the election year. It's going to be absolutely nasty. And the bottom line is let small business people be small business people.
Right.
And I'm on the Small Business Council of America. So I get the emails and the talking points and all that. And I read those things and I'm just like, gosh, how many more regulations can we put in place that they're going to slow us down from growing
red tape.
Our businesses are red tape. So, but yeah, you've got, in 24, you've got a nasty election coming up. You have a current president that is actively trying to put a former president in jail. You've got, or he's not. I don't think he's responsible for anything because I
don't think he's really trying to do much.
But the people that are there, that are there, and then the guy they're trying to put in jail is crazy.
I know.
So I'm like, I got to choose between a crazy person and another crazy person is how I see it. And this just sucks for America. It sucks for business.
Yeah, but neither one of them might be the choices come November.
Maybe not. I mean,
we will see.
I would love for someone in their mid 60s to run for president.
Not upper 70s.
Or is Biden upper 70s?
No, he's 80.
Yeah, he's 80 something and Trump's 80 something. They're just two crazy old people.
Mm-hmm.
Yeah, and just the childlessness on both sides, and it's just bad for America to keep dividing us like this. And then people who get their news from just, mainstream news, these people are getting so angry.
Yeah.
People are just angry. There's angry people out there.
It's just not a good look for our country, period.
Just not good look for people's neighborhoods. I mean, forget about the country level. What about your neighborhood?
Oh, yeah. You mean neighbors against
neighbors?
Yeah.
And just people that used to be friends can't talk to anybody. Now there's grumpies. Oh, there's a Trump sign. Oh, there's a Biden sign. Oh, they're Biden people. I'm like, you know what? At some point, everyone should be voting. We should have 100% voting. And at some point, maybe we need to go back to the old days where we didn't talk about it.
Yeah. It was just unspoken.
Talk about politics or religion, right?
Yeah.
Or taxes. Or income, whatever. So yeah, that's just what I'm bummed about. I think for this year, I just like for it to be over, and for all those people who's like, oh, he's a Trump supporter. May I remind you that the data shows that you want a Democratic president and a Republican House and Senate. If you can tell me how to make that happen, I don't know how you make that happen. That is the best for the stock market every single time. How Republicans in the House and Senate, Democratic president get more done for the good than any other scenario in history.
Balance of power, definitely.
That's it.
Yeah.
So maybe you keep Biden in, but you got to make sure you got a Democrat and Republican Senate. But people vote tickets now, right? People don't pick and choose anymore. People just are hardliners. So I don't know how you make that happen. But when it has happened, it's been good. So I think typically, what is it? A whole party gets in, and then after the 2 year, then the House and Congress will shift back. Those have been the best economic years for our country. So.
And usually the market has done well in election years. I don't have specific stats, but
yes,
typically it does.
That's
do
very
well.
true. Which now people are emailing me. Clients email me stuff all the time, but now they're emailing me. The government's trying to manipulate, or the Fed's trying to manipulate the economy for Biden so he can win the election. I'm like, well, they did it for George W. They did it for
every president.
They probably did it for everybody
history.
but Trump. I would say
Yeah.
that no one seems to
do anything.
do anything for Trump. But yeah, if you believe that, the Fed's supposed to be independent, right, Andrew?
They're supposed to be.
They're supposed to be independent and do what's good for the economy and what's good for America. And I don't know. It's
We'll
pretty easy
see.
to sink into these political theories, and
But that should be independent of your long-term investing.
it has nothing to do with
Exactly.
investing. That's what's so frustrating about the whole thing, is it has nothing to do with your portfolio.
Amen.
Nothing.
Game over.
Now, I will argue. I would argue the only exception was when Bernie Sanders was running. He was he calls himself anti-capitalist, right? So he's anti you owning a business. He's pro the government taking over your business.
That was scary.
and if the Democratic Party had been set up differently, you wouldn't have had a Hillary, because the super votes, right, for Democrats. You wouldn't have had a Hillary Trump election. You would have had a Bernie Sanders Trump election.
Mm-hmm.
And that would have been hilarious. Also very scary, because you literally would have put capitalism on the balance sheet, or on the ballot.
On the ballot, yeah.
Where we don't have capitalism on the ballot right now. I don't see a scenario where people are saying, "Oh, all these public companies should be government owned." Wow. Right. So to me, I'm like, okay, well, as long as capitalism can survive and we can be free thinkers and doers and create things here, people are still getting off the airplanes in this country, still creating companies in this country, developing AI, developing all these things in this country. They're not doing anywhere else. Smart people are coming from other places here.
True.
But they can't do it there because they don't have the capitalist structure that we have.
Are you curious why annuities keep coming up as a potential investment option? People are often told that annuities can effectively mitigate investment risks and help secure their financial future. However, annuities often benefit the salesperson and might not be the best choice for you as a consumer. To learn more about the various types of annuities, the negatives of owning them, and better investment alternatives, we have a free ebook on our website just for you. To download our ebook, Buyer Beware, Why Do They Keep Trying to Sell You That Annuity? Simply click the link in the episode notes or visit wiserinvestor.com/guides. Now let's get back to the episode.
So, I mean, this is not our politics episode, but another angle on this, Missy, is we have expiring tax changes. Was it January of 26? We reset back to 2019.
Yeah, the Tax
code?
Cut and Jobs Act, TCJA, expires at the end of 2025. So all those nice tax cuts that we've all taken advantage of, both as individuals and corporations.
Yeah.
So we have to remember that, yes, corporations get tax cuts and we think, oh, big, bad, greedy corporations, but it all trickles down to consumers,
Right.
and helps us with the goods and services that we purchase.
Yeah.
So that could all come to a screeching halt at the end of 2025, both in the tax rates that we pay personally at the federal level on our own 1040s, and then in the goods and services that we buy, everything, because it's
corporations
all,
are going to cover that bill.
Yeah.
They're going to pass it down to the people buying it.
Exactly.
So yeah.
So
They're not going to cut their
But
margins.
that goes back to common person watching TV is never going to connect that.
no, connect
corporations
those
should be
dots.
paying their taxes. Well, who
Yeah.
pays their corporation taxes? You do,
You.
the purchaser.
Yeah. And shareholders, hello,
Yes.
all of our investments, our long-term investments are
Correct.
going to be hit.
Yeah.
So, that it's a big deal that those tax cuts are about to expire. So, we don't know what, Congress will do.
We don't. We also have expiring estate planning
Oh.
rules, right?
Big deal.
And we've talked with other attorneys that come on the podcast about that. But yeah, right now as a married couple, 24 million ish is where the exclusion is. So if you have a net worth above that, you're going to pay almost 50% death tax on money above the 22.
Mm-hmm.
But then that number is going to get reset. So we think it comes down to maybe 11 to 15 somewhere in there for a married couple.
Mm-hmm.
That's a much lower number. And if you look at projections for most of our clients, especially the younger ones,
Oh, yeah.
their net worth's going to be way over that.
When we're looking at pilots and projecting out their,
Right.
net worth,
So
there's a
that's kind
lot
of
of people that could creep into an estate tax situation. So
Correct.
whole new realm of planning.
So the end of 25 is when all this would have to start being planned for. You wouldn't plan for that now, but January of 26, we could wake up to a different world. Again, depending on how the election goes. So
Exactly.
there's a lot of important things on the docket, as there are every 2 to 4 years. Well, let's celebrate 23. Cue the confetti.
Yeah. Wow.
This
Who
was
knew?
This was a year that was doomsday. We're going to have a deep recession. The world was coming to an end. Everything that you read said this. Everyone agreed. Yes, definitely a deep recession in 23.
The 60-40 portfolio is dead.
Oh, the 60 portfolio died multiple times in
Yeah.
23. Andrew, what did the S&P do? 28, 25, 26? What was the rate of return?
The S&P was up over 26%.
26% rate of return in the year that everyone said you had to be in cash because the world was going to fall apart.
It's incredible.
Yeah, most analysts were calling for a recession. It never happened. I think, a lot of reasons why equities did so well was, for one, inflation sort of, I don't want to say stabilized, but started, coming off its peak, and, lower inflation. And then also the Fed signaling to the market back in November that they're pretty much done with the rate hiking cycle. And ever since then, there's been, not upward pressure on interest rates, and rates have been declining, which is a positive for equities for the most part. So all that, and then there was AI optimism and enthusiasm. A lot of companies like NVIDIA were taking advantage of their AI products and their applications, and causing synergies to their bottom and top lines. And then also too, it's kind of interesting. I saw a chart that shows, just corporations in the SP 500. A lot of them, back in like 2019, issued debt at a very low interest rate. So a lot of the larger companies have a lot of lower, interest rate debt. And this didn't really affect their, net profits like it would in the past in traditional rate hiking cycles. So a lot of them were able to maintain their profit margins and still deliver on their projected guidance.
I was looking up something when you were talking. So 26% on the S&P. Spider's gold ETF last year was up 9.6%. That's not horrible, but for all the doomsdayers,
Yep.
Right.
you missed out. And then over the last 5 years, you've averaged 9% per year. The S&P is giving you much better than that.
Definitely.
Over 3 years, it's 1.26%. The 10-year annual return of GLD is 4.73%. 10 years. Compare that to the S&P. I mean, that it's you're losing so much money with these fear trades.
Yes.
Right.
No need to rush to gold and silver, please.
No, and that's where obviously 2022 was one of the most historic worst years for bonds, but that's where bonds do come into play. Traditionally, is they offer that diversification, and that a lot of people use gold as like a hedge or a diversifier, but really bonds are a more efficient and better diversifier than gold.
Yeah, the short-term bonds, especially, except for 22. That was only one time, and was it three times in history that's happened?
Yes. Yeah.
Since the 1920s. So chances of that happening again are pretty slim. Okay, let's talk about fixed income. So we had a 5.5%. Is that the ag return last year?
That's U.S. bond market, the Barclays aggregate. was up about 5.5% through 2023. Interestingly, talked about it earlier, most of that return came in the fourth quarter. And that's really when the Fed signaled that they're done with their rate hiking cycle. And that's when, not to get too technical, but longer duration bonds started to outperform. And that's, bonds that are, maturities of like over 2 years and, 2 years to the US bond market's average duration is about 6 years. So, you can think about it again, that if there's a 1% decline in interest rates, for every point of duration you have, for every year of duration you have, that's, it's not perfect math, but that would equate to about a 1%, increase in price return. So 6-year duration would equal about 6% price return for 1 percentage point decrease in interest rates.
So, Andrew, does this mean the yield curve is becoming more normalized?
So it's funny. I was looking at earlier today, the yield curve is still very inverted, meaning short-term interest rates are higher than long-term interest rates, which is not a typical economic, which is typical in economic cycles where typically, the yield curve is upward sloping. And that makes sense because long maturity should have a higher yield due to a higher risk premium for that liquidity. Right. But longer term rates have declined more, but the Fed funds rate is still at 5.25. So the shorter end is still up higher. One thing I think that could be a positive tailwind for markets is I've seen some people forecasting that there could be a possible uninversion for the yield curve. I think that would be kind of difficult, but if the Fed does cut rates and if it's not due to a dire economic situation, and they were able to cut rates 3 to 5 times, that could cause that shorter end to come down and be somewhat more normalized. But an inverted yield curve is very bad for capital markets, and so far nothing's broken or nothing has broke yet. But
I had this video sent to me. I couldn't watch it. I don't subscribe to Tucker Carlson on his new platform, but a client does. And he had a guest on basically claiming that the government is manipulating interest rates for the benefit of the Biden administration. And I was like, well, first of all, if you think that the Fed manipulates based on politics, you're probably right. And that's always happened. It's not something new and you just don't like the players. But the second part is everyone assumes that there's going to be a drop in interest rates in the third quarter of next year. Now, why do they assume that? Do they assume that because they think there is a mild recession that could happen and Fed would need to lower rates to spur on the economy? That makes economic logical sense. Otherwise, why are we lowering rates? Why are we talking about lowering rates?
Yeah, I think a lot of those comments were in reference because the Fed has been pretty set in stone that they're going to hold rates higher for longer. They don't want to risk inflation creeping back up and adversely affecting the market in that aspect. But I think late in December, Jerome Powell and maybe some other Fed board members came out saying that they actually may look to cut in early 2024. And that's where I think some of the speculation came into play. But the market's kind of always priced in, and I was looking at it, I think there's like a 50% probability of 3 rate cuts by June. So there is, and there's always a small percentage of a recession.
That's like second quarter.
Yeah. So, whether and I still think the Fed's going to be dependent on inflation, and I believe there's going to be no action at the January meeting. But if inflation continues to be tame, they might actually ease and do a rate cut here or there. I don't think there's going to be any drastic cuts, but I guess we'll see. Time will tell.
I sat here in the room and we're going over our assets under management and where our goals were for the year, growing as a firm. And I remember Andrew sitting in the corner over there going, I think we're going to stay right here because there's really no reason why the portfolio should be dropping by year end. No one has ever said that to me. Mm-hmm. And you know what? He was right.
Yay!
He was right. I think that's like the first prediction, right? He just looked at, remember that? He's so confident. Mm-hmm. Well, yeah, there's no reason why the portfolios would drop between here and December 31st. I should have asked you about the second and the third of January.
I should go get a lottery ticket now, I guess.
Yeah. Mm-hmm.
That's right. I'm a terrible short-term predictor of the markets because I focus on the long term so much. But, when we think about lowering interest rates, I think about now, if you lower the Fed rate, it doesn't directly affect mortgage rates. That's really more tied to what 10-year used to be the 30-year.
Yeah, there's some like spread between the 30-year and the 10-year.
Right.
It's some math behind that,
but when you listen to our recent podcast with Tom Townsend, our realtor expert, our realty expert, he was saying that if interest rates came down to 5, home prices are going to just like be bid up again. It's going to be mayhem, which promotes inflation.
Yeah.
So you just wonder, do they really have room to lower rates and not have an inflation problem?
Yeah.
Because some people are angry that they kept rates as high as they have and they raised them so fast. Mm-hmm. But inflation year over year is 3%. People laugh at me when I say that. But CPI is 3%. Inside CPI, groceries are probably up 10.
Yes.
Yes.
Okay.
But the average is 3. So, any thoughts on that? I mean, why I just don't understand why they would lower rates.
Yeah. And I think, and this week, I think the Fed's actually walked back on on those late December comments. They really want to be data dependent and data driven, and again, not have inflation just kind of bubble back up.
Yeah.
So I still think it'll be interesting to see what happens and what they communicate after the January meeting. But I still think they're going to hold rates at the same level, at least for a couple meetings. But again, the market is pricing in.
I can't help but chuckle when you say data driven. All their data is rearward looking data. They don't use any forward looking data. So that just tells me when they do lower rates, it's going to be it'll be too late.
They say they're data driven, but yeah, it might be the wrong data.
But the data that they produce in that report is all rearward looking. None of it's forward looking.
Right. That's true.
Okay. So let's move on to 24 outlook. Well, I've got your notes here. You can read off your notes just as well as I can.
So, the SP 500 right now is around 4,700. I think most of the major, institutions, banks, analysts are calling. It's obviously always a wide price range end of year target. I think the most bearish, actually, interestingly, is JP Morgan at 4,200. Goldman Sachs is at 5,100. They're one of the more optimistic. And then Capital Economics is a research provider. They're at 5,500. They're the most bullish that I've seen. So obviously the range is between, from 4,700, about 7% price appreciation to minus 11. So
got it covered.
Kind of coin toss there.
Yeah.
But just kind of digging in a little bit further. If you look at like the EPS targets and the current valuations, most of the EPS
that's earnings per share.
Yes, EPS growth is flat, and the forward valuation, and when I say valuation, I mean the price to earnings multiple, that is also about 0% increase or unchanged. So a lot of them are basically pricing in no growth, even though that their price targets may range, and then flat to no growth, and then also little change to the valuation.
So basically, companies' earnings aren't growing.
Yeah,
and maybe a slight drop in earnings actually.
Wow.
Yeah, and that's one of my, I think, biggest concerns is we had such a great run up in Q4 2023. I think a lot of this could be priced in, and if there's any kind of misstep in and they're pricing in maybe a softer landing on the interest rate hiking cycle, and that they're able to ease rates without their cuts of a recession. My fear and valuations are higher because of this, because we had a lot of price appreciation last year. So my concern is that a lot of this is currently priced in, and if there's no kind of catalyst to drive us higher, like companies further developing their AI technologies, or if high interest rates are persistent and are more restrictive to company balance sheets, then that could be a concern.
What are some of your predictions on themes for 2024?
So we kind of already talked about these. I will say lower interest rates and lower inflation. And when I say lower interest rates, not necessarily, I think just the Fed, even if they have to raise one or two more times, I think there is not that upward pressure on rates. So I think, even if they don't cut as much as the market is expecting, there's kind of going to be a continued downward trend, which, that would benefit, again, longer duration fixed income. And then also just inflation. I feel like inflation will kind of normalize, continue to normalize and come down, as long as the Fed keeps rates high and at the appropriate level. We already talked about it earlier, heightened volatility. I feel like there's always last year's volatility, to me was below long-term averages. And I think, obviously because of election year, still a lot of uncertainty out there with geopolitics, wars, we're gonna have a lot more volatility in the markets. And, as far as, I put some themes on here, we're not really style pickers or, sector rotators, but I think, just, as far as like predicting things, I think a good barbell between like high quality, stocks and the tech stocks, stocks that have an emphasis with this growthier technologies that have done well, and there's a lot of momentum behind them. And again, like a lot of the quality players, like that have like good valuations that were kind of hammered last year. I think some people might be searching for good value, and that will do well this year.
On inversion of the yield curve, Missy's already asked that a little differently, but
that could be, if they do cut the short end, that could be a positive catalyst for stocks as long as it's not in connection with a recession.
Wah, wah.
Yeah, what do you think puts us into a recession at this point? Because they're not getting the jobs. The jobs, we keep increasing jobs. People keep spending money. I don't know where it's coming from, because the credit card, I guess it's credit cards, but
and that's
loans.
The recession definition in America, right? With the jobs.
Yes, with the jobs.
Additive. Mm-hmm.
Yeah, we would have been in recession already if people didn't.
2 negative quarters.
Yeah, but even with the sell-off in the tech sector, or AI taking so many entry-level tech jobs, those people that clearly were reemployed somewhere.
Yeah, so we're not taking the hit in jobs. So,
right.
Yeah, and immigration too. It's always, a recession's been caused by an unforeseen catalyst. So, I think the conditions are still kind of primed. I mean, there's a lot of risks still out there. A lot of these traditional indicators are still flashing recession signal, but then again, there's a lot of, on the flip side, a lot of positive economic data points, like again, stronger growth and that stronger than expectations, and then, strong labor market. So kind of have these battling forces here.
So it would take a major catalyst probably to get us off of that.
Right.
Which would definitely change the White House. I don't think we've ever had a sitting president get reelected during a recession.
Right.
Yeah, no.
Yeah, it's never happened. So what are some surprises? And this is a little, putting you on the spot. I would say that you have one of these major, or one of these regional wars that becomes a major war. I think that could be a shock to the market. Israel's doing their thing, fighting Hamas, and but if that blows up and creates, Iran gets involved, and then the US gets involved, and then Russia's involved, and then you've got Ukraine again, which is a whole nother front that, man, I mean, those poor people there. I remember when that war first broke out, and I thought, this is probably like 10 days.
I know. And here, what, it's a year later?
Yeah, but it's still fairly contained. And there's so many other wars too that we don't even make the news cycles right now.
Yeah, I think
that are happening.
If China were to invade Taiwan, that could be, and who knows if that will happen, but obviously,
I just, China's such a train wreck right now. That would just solidify their train wreck.
Yeah.
that would become an official disaster. I think that's more pandering of beating the drums, but I don't think that would actually ever happen. I don't know what the incentive would be.
You don't?
No, not now. Their economy their economy's in shambles.
Yeah, but do they really care? I mean, it's more about just,
I guess,
a land grab.
Maybe if they need a distraction from how bad their economy is.
Yeah.
And what a facade and it is, I don't know. But that's beyond my
It's like,
expertise.
yeah,
We would
hey,
need to
look
bring
over
in
here.
we need to
Mhm.
bring in someone who's an expert on China to talk about that, because that is
True.
not
Right.
my area of expertise.
Yeah,
I
I
just
don't
know
know.
I don't want my money there. I know that.
Oh, no.
Yeah.
Yeah, it probably, maybe some politics here potentially that could cause some additional drama, but it would be short term. It'd be very short term.
I think, if there's any noise, Q4 of next year, hopefully the dust
Mhm.
settles by Q1 2025. But
Yeah. I think the most important thing, and there's always going to be an event that pops up that was never on our radar, like a COVID.
Oh, yeah, here.
Yeah, here. But and that could be a catalyst for something negative. But I think the important thing that I would want to say to everyone is just be careful and understand where your news is coming from.
Good point.
And we've had whole podcasts associated with this in the past, over 201 episodes. But it's like, I remember when Brad was working with us and I found this article that we talked about value stocks for one particular year. And I was like, oh my gosh, this guy's really convincing that value stock growth is done. And I sent the article to him and he responds back. He goes, the guy who wrote it is one of the largest value money managers in the country. I was like,
It's
of
AQR.
course,
Yeah.
that makes total
Yeah.
sense. Or the guy that shows up on CNBC every now and then. I won't say his name because I don't want to promote him. But his whole thing is like, oh, this is all coming crashing down, blah blah blah. Well, he runs a hedge fund that benefits from things crashing down. So it's the gold commercial on TV talking about inflation. Well, because they want you to buy gold. It's the option trader that says, buy these options, you'll make money overnight. It's because they want to sell you a newsletter and make more money on the newsletter than they do in trading options themselves.
And they're already probably in these investments and they're just more.
Yes, absolutely.
bid up.
I would love to think the world is as innocent as I would like it to be in my head, but it's not. And you're being sold things. It's no different if you walk down the Edward Jones or any of these other shops and they want you to buy the annuity.
Oh.
It's the same thing. There's a 10% commission sitting on the side of that. There's no benefit to you for owning it.
No.
I can put you in the S&P 500 and put you in short-term treasuries, or heck, today a CD, and I can mimic the exact same thing at no cost.
Exactly. It's not hard.
But those guys aren't trained to think. Those guys are trained to sell.
You're right. That's their job. They're salespeople.
They salespeople. They sell stuff, and that's what's so frustrating is that people go in and go, "Oh no, their whole thing is they make sense of investing and they help and guide me." No, I can show you their commission schedule. It says nothing about guiding. It's all about selling. That's what they do.
Look at the prospectus. Yeah.
So as you roll into 24, this is the year to open your eyes and realize that it's not as warm and fuzzy as you would like it to be. And understand that people are trying to sell you.
Yeah.
That's why we try to have this unbiased podcast. That's why we run an unbiased company.
And yeah.
We don't sell anything, right?
Long-term healthy asset classes.
Right,
How many
exactly.
times do we have to say it?
I know. And so many people think that there's like a secret to investing. And you know what, guys? There's not. That's why we're a financial planning firm first that happens to do portfolio management.
Absolutely.
You know something else?
Cost.
You know something else? And I'm going to do a short video about this, but you know something else I found out recently?
What?
And I suspected this, but when I found out, it just made me feel dirty. So everybody knows that I have a background in aviation. I flew in the Delta system for 10 years and used U.S. Airways system for 2 years prior to that up in the Northeast. And so we have a lot of pilot friends and we have a lot of pilot clients, about a third of our client base. Well, if you count hourly people, we probably get over 500 pilots.
Yeah.
So we have a strong aviation community here at Weiser. Well, there's another firm that manages assets and they want to manage your 401k plan for 0.5%. And I keep telling these guys, like, guys, look, you need to do financial planning. We have free allocations on our website for your 401k plan. Go download those. If you don't believe, we'll give you a custom one if you come through for the planning process. It's a one-time fee, small hourly fee for updates each year. But if you pay 0.5%, you end up paying over $2.5 million in fees
over your
career.
life. Yeah.
Wow.
Yeah. You need an asset manager for retirement. You don't need asset management necessarily when you're accumulating assets inside these big 401k plans because they have
Yeah.
everything you need,
At
right?
0.5% a year.
So that has resonated. We have so many clients now, especially from the Delta side, starting to get some from United American now. But then I started thinking, I talk to these guys and they say, I flew with this guy and he's really pushing this company. It's an Allworth company. Allworth is a private equity firm that buys up RIAs. And I started thinking, why are they so advocating for this one company? Why would a pilot do that? It's strange. And then we went to their disclosures for this company, and basically they are paying pilots to refer pilots.
Oh, no way.
So here's the conflict of interest here is that you're flying with a person who had to hire a financial planner because they're not one themselves.
Right.
And that planner says, hey, I'd like to have more people like you. So I'll tell you what, I'll give you a commission. So for every person that you send me, you're going to get a trailing fee forever.
It's a pyramid scheme.
It's a pyramid scheme. So I'm like, holy crap. So you can't even trust your own brother or sister sitting next to you. So I do want to say that we do not pay solicitor fees. And if you want to see these solicitor fees, if you want to know who they are, I know who these people are because they have to be disclosed.
Yeah.
And some of those are in the union.
Wow.
They're union in the union representatives. So that creates a whole nother level of complexity. It just made me really sad because when I was there and I did RNA workshops, it was, hey, free advice.
Free advice.
We're going to help these people as
true best interest.
If they choose us as a firm, then that's great. But that's not why we're there. We're there to help people. And anyway,
that's sad.
So that's a whole nother thing of people getting sold. And you always have to understand, how do you get paid?
Mm-hmm.
And where is the information coming from? But anyway, that's enough of my soapbox, guys. Thanks for listening. If you're interested in learning more about Wiser Wealth Management or want to schedule a consultation to meet with one of our fiduciary financial advisors, you can do so by going to wiserinvestor.com, or you can click on the link in the episode notes below. And that's great. See you guys next week.
See ya.
See ya.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening. That way you don't miss any new episodes. We'd also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. This episode was produced and edited by Ken Hoadley.